do it that way. So we have to go ahead on and let them in our, oh,
I hit them in all. Hello, everyone. My name is LaQuanda Witherspoon, and I am with the Strategic Initiatives Division of the Office of the Chief Procurement Officer. We are really looking forward to having you for today's webinar, which is our financial capacity series, one of three. So really briefly, I just want to go over a few housekeeping rules before we get started. Number one, please make sure your audio and video is turned off so you are not a distraction to the speaker or the other viewers in the meeting. There will be time for a Q&A at the end. However, we do encourage you to use the chat feature to pose any questions so myself or my team can assist with answering those questions for you. Um, yeah, and that's pretty much it. Yeah, and there will, like I said, there will be team members on the call who will be answering any questions you may have. And also, we're going to ask you to take a brief survey at the end, so please do that also. But without further ado, I am going to turn it over to Josh with the WBDC, who is going to be presenting for you all today.
Outstanding. It's a pleasure. Thank you so much. And I wanted to compliment LaQuanda and Lynette and Sabrina. Uh, what you're doing is fantastic, and it's such a plus to have a Cook County procurement trying to build the businesses. It would be so much easier a job of them just to go with the good old boy network and let just those businesses serve the Cook County. But what they're trying to do is build up new and build and expand the supply chain to make sure that we get the most diverse voices and the disparate kind of perspectives and the amazing innovations that all different communities bring. So I applaud you, Lynette, and I applaud you, LaQuanda. This is really amazing. So without further ado, I also have on the call Kelly Gumbiner is with our group, and we're going to get to that in a second. So without further ado, let me see. We also have some housekeeping. That you feel free to use the chat to ask questions. Kelly, I'm going to rely on you, and I'm going to show Kelly's picture in a moment. Rely on you to, and I wonder if I could throw me a chat if you can't speak. And then feel free to ask questions. There are no bad questions. And then we'll share resources after the session. I'll send this to LaQuanda and Lynette. And then please remain on mute and I would love to see you so you could have your cameras on. And then and hopefully we can get everyone here to commit to staying engaged and learning 3 new things today. So let's see what we could do with that. And let's see, very good. Nobody took me up on showing their camera except for Kelly. We also have, so I'm just going to give you a little bit of background on the Women's Business Development Center. Our mission is to support and accelerate business development and growth by targeting women and serving all business owners to strengthen their participation and impact on the economy. So we are here, and we really appreciate that the Office of Procurement thought to invite us out to talk to you. Today we're going to be talking about financial statements. Next week we're going to talk about the break-even analysis, and the week after that is going to be pricing. It's going to be a blast, and the idea is that it is going to be an opportunity just to expand your mind and to talk a little bit about these very important issues. In the meantime, our WBDC, you should know, is in 9 states and 5 major markets. So we will be, if you happen to be in Kansas City, we're going to be given a data to revenue program in Kansas City probably this summer. And Kelly, you don't know this, but I just wrote you into the grant. But anyway, this is who I'm talking about. This is Kelly Gumbiner, my director, and I'm her managing director. So we were working out. I'm basically the admin here. Kelly is the director of programming there, and then we've got two associate directors, Emma Westfall, who is our associate director, and she focuses on our our direct lending program, loans up to $50,000. And Dania Beal is our associate director, and she focuses on the Kiva Capital Access Manager. Kiva is a nonprofit loan that is a no interest loan for up to $15,000. So that gives you an idea there. But we are committed in our group. See, the WBDC is a nonprofit that has a group for established businesses. These are businesses that are more than 2 years old. We have got two different groups for startup and emerging businesses, and we've got an innovation group. And we're the Access to Capital team. We're the Access to Capital group, and we are here to help you find the right capital at the right time from the right source. If you want to schedule with us, the truth is we don't charge any fees. We like to connect you to capital sources. We like to help you grow, and this is, I think, why LaQuanda and Lynette invite us out to present to you today. So if you can, and I'd love for you to do this, can you put your name and your business and what do you hope to learn today? This is going to, I'll take a look at the chat. If you can go ahead. Thank you, Sabrina, for having your camera on too. Let's see, can you guys put your name, business, and what do you hope to learn today in the chat? I'm looking to see if anybody is putting anything in the chat, but not. Okay, I guess you're gonna see in the recording. So we're unlocking the path to limitless achievement. We're unlocking the path in operating a successful business, and there are no constraints. It's bound by dispelling the myths surrounding financial management, such as the belief that a CPA or an accountant handles everything for you. Let's explore some common misconceptions. Okay, so I listed out here, and this is basically the basis for why you're going to be in this seminar, as well as the next one and the following one for this Cook County Office of Procurement video series. The first is that a lot of folks believe that accountants handle everything, and we see this a bunch. And we actually try to battle this perception because on the green side, business owners should understand and manage their financials, even with a CPA. This is very important. The CPA gets everything together and it makes your job easier. But what we shouldn't do is let the CPA do the numbers and then you ignore it and you just move on. I applaud every one of you for getting onto this call and to watching this video, because what you're doing is taking the initiative to say, I am not just going to let the CPA handle my numbers. I'm going to have the CPA do my numbers, but I'm going to review them and know what I'm looking at. And that's what we're going to do today. And financial statements are only for taxes. On the other side, financial statements are crucial for informed business decisions. As Kelly famously put it, you could use your data to drive stronger outcomes. And then we have complex financial jargon that's too complex for you. We're going to talk about financial concepts that you're going to have full understanding of very shortly. And financial education is expensive. And the truth is that's not the case. The Office of Procurement is making this opportunity for you free of charge. And there are many opportunities. Check out the different opportunities that you could get to explore and to expand your financial acumen. And it's all about making money. And the truth is, financial education includes resource management and sustainability, and you need a lot of money to invest. And the truth is, there are different investment options for different budgets. So that gets a little bit into other stuff we're not going to cover today. This is what we're going to cover today, the 3 pillars of financial statements. And so the truth is, this is the driest stuff. And I'm so proud of you for being on this call, because who ever takes the time to really think about the balance sheet, income statement, and cash flow statement, the 2 major documents of financial statements. And these are the financial statements that a bank would ask for, that any kind of lender would ask for. The balance sheet offers a detailed look of what your business owns and what your business owes. The income statement provides a breakdown of your business's earnings and expenditures to assess the overall profitability. And your cash flow statement sheds a light on the origins or destinations of your cash flow. I often think of it more like this. When the balance sheet, every one of these statements is really important to you, but they're important to you for different reasons. And you guys are, Alexandria, you forgot to put hoping to grow and understanding business capital, accessing funding, and best practice to manage my financing. Perfect. Thank you. Thank you. That was a text. So what I like to tell people is, and by the way, by the end of this, we're going to ask you what is your favorite financial statement. So we're going to ask you that at the end of this program. So get ready. Now, the balance sheet, every one of these statements is important to you for different reasons. And I think of it like this. When you meet somebody at a party, what do they ask you? They say, where do you live? And you know what? They're making a micro impression if you tell them where do you live? And they might even ask, do you own your house or do you rent? They're asking you about your assets right there. They're trying to figure out at a snapshot, a picture of you. This is like a picture of you generally. Okay, that's what the balance sheet is. It tells your business as a it's your business at a snapshot, and it is, where do you live? It's do you live in a house? Do you rent? Do you have your own car? What kind of car do you drive? You know what I mean? These kind of questions at a party, they're basically asking for your balance sheet. So then when they ask you, how much do you make? If they're so cheeky to ask you that, you should probably walk away. But let's say they did. How much do you make? That's your income statement. That's what a bank wants to know. How much do you make? And you could say, I'm making $250,000 a year, and I hope you believe that's what I'm making, because that would please me so. But let's say I tell you that I'm making $250,000 a year. That's my income, right? That's my income, and that's your income statement. And basically, at the end of that, we're going to get to talk about profitability and net margin. But if somebody says to me, and I tell them I make 250,000, and then they say, "Come on, how much do you really make? How much do you really bring home after all that? How much cash do you really have at home?" And that's the cash flow statement. That's like literally, it's not how much I make necessarily, it's how much cash. That's the statement that tells me how am I doing cash flow wise, like cash in the bank. Like what am I working with, and how am I feeling? And the truth is, the cash flow statement is going to be really much more true to your feeling of how your business is doing than the income statement. But we're going to get to this much more in depth. We're going to take each of these sheets one by one, okay? And then in an exciting twist, we're going to have a test, so get ready. And again, at the end of this, you're always thinking, what is my favorite sheet? Okay, so ready. Let's begin. The balance sheet balances assets on one side and your liabilities and equity on the other, okay? So this is everything that a balance sheet is. Now, let's go through it a little bit. What are assets? So that's to say, what does your company own? Their assets do you own your own property? Do you own the own building that your business is in? If you are renting, that's going to show up on your income statement and cash flow statement, okay? Property is what do you own? Equipment, do you own equipment? And then you take out depreciation. If that's a way to that your accountant can show over time the devaluing of the value of your property. You would do that because that will show up on your income statement and on your income statement so that it'll decrease your taxes. But anyway, we get ahead of ourselves. Accounts receivable means where you have billed out and you're waiting to be paid back. That's receivable. Those are all your accounts that are out there that are ready to be paid. They're ready to be received back. So there's a value to that. There's a value to your business. If you have $20,000 in invoices out there that have not been paid back, those are your accounts receivable, and that's a value. And the big one is cash. You're going to show cash. How much cash do you have in the bank at that time, at any particular time? And also inventory. Other things that might be on your assets are things that are owed to you, lease improvements, raw materials. These are kind of assets. You can imagine if somebody owes your business money, like your shareholder, or if you own the business money, you show that as an asset because that's an asset to the business. The business is going to get something for it. I'll keep on going, and then we'll do questions. Kelly, are there questions now? No questions. Okay. Then let's go to liabilities. So liabilities are what your company owes to others. What are you liable for? So in criminal cases, what are you liable for? That could really be like, are you guilty? But here, where we talk about liabilities, it's more about what do you owe? What are the different papers that you owe, for example, like loans, terms and lines of credit. This is what you owe to the bank. They gave you some money and now you owe payments back. Equipment car loans and equipment loans and car loans. These are, again, you have the value of a property that you showed on your asset side, but here you might have some loans that paid for it. Those are liabilities. Now, accounts payable those are all the bills that you have on your desk that you have to pay. Just like they had an account with you, you have accounts payable that you have to pay to them. Those are accounts payable. So we had accounts receivable on one side, accounts payable on this side. And you have loans to shareholders. Sometimes you have prepaid work that's owed, or you have accrued salary that's owed. That shows up as a liability. And tax payable, the sort of payable stuff is going to be in your liabilities. And then you get to what is equity. Equity is retained earnings. So anyway, equity is this, that, remember how I showed that it's going to be balanced out. So assets and liabilities are not going to be the same. They simply are not. Unless there's some quirk, but the value of your assets and the value of your liabilities are not going to be the same. The difference is your equity, right? Because it's going to balance. And why does a balance sheet balance? Is specifically to show the equity. That, in other words, you need your balance sheet to balance because you want to have a clear picture of what, in a snapshot, what is the value of your business. And ultimately, there is where the value of your business is. They're going to get a picture of what your business is all about by your assets, and they're going to get a picture of what's called levered, how you leverage, how much loans you're going to have that sort of takes a little bit out of your assets, but nonetheless, you got assets, right? But the truth is your value is going to be, a banker is going to look at your equity and it's going to say, how much retained earnings? They're going to zero in on the retained earnings line because the retained earnings is the addict of, let's say you put all of your income statements from all the years, all your profit and losses from all the years into your attic, into a basket in your attic, and you brought the basket down. That's your retained earnings. That is the running tally of all your years of net income or loss. Okay, that is your equity line. And so basically that line, if your liabilities is less than your assets, then your owner's equity is going to be larger. Okay, that means, and that's great. You don't really want to have a negative owner's equity. If you have more liabilities than assets, you're going to have a negative owner's equity, because that way the two sides will equal. Are there any questions now? Could you come off mute, or do I have to?
There's a question regarding that one of the participants wasn't able to activate sound, and they wanted to make sure they can get a copy of the recording. We're recording, correct?
Hi, yes, we are recording,
Okay.
so there's no worries with that. Yeah.
Great, thanks.
Good question. Were there any questions about the balance sheet or no?
No.
Okay. Let's move on. So this is, we're going to actually show you a balance sheet now that I've talked about it to death. This is a classic balance sheet. This is where you have, it's as of a certain date. You have what you own on this side, that's the asset line. And look how we have current assets, fixed assets. We'll get to that, and what you owe. And so the things in long-term liability. Okay, so this is what I wanted to show you here. These are two different times that you'll see, current and fixed. And this is current will be any of your loans, for example, that are less than 12 months is what's going to be in your current liabilities. Any loans, any portion of your loans that are more than a year old are going to be your long-term liabilities. For example, a mortgage on your house is going to, if you have a $250,000 mortgage on your house, a portion of that, maybe $5,000, is in your short-term current liability, short-term loan portion of it, the current portion of that long-term debt. And then the balance of it will be long-term debt. You'll also have credit cards that are short-term loans. Credit cards will be in the current liabilities section. By the same token, your inventory is going to turn over within 12 months. Your accounts receivable should turn over within 12 months. That's the reason why they're current assets. Long-term assets will be fixed assets, is what it's called. So that rounds out the balance sheet. So we'll move on to the income statement. So that is your balance sheet. Now, the income statement is, what did you make? What did you make? And when people say, when in the business world, if somebody says, what did you make? You're going to ask them, what did we make or what did we profit, right? So then we're going to get to that. Now, keep in mind, what did you make? The statements you're going to get from your CPA, they're going to be either accrual or cash basis. These are terms in case you don't know. Accrual, like it's a little cruel that you don't have the money yet. That's how you remember it. Accrual means it's billed, but it has not been collected yet, okay? Cash basis it's a whole statement that's based on only money that you've collected and what you've spent. So this is, but mainly people do accrual basis income statements because the top line number is we made $1 million last year. It wasn't necessarily that we collected $850,000. We made $1 million last year. And it just, it's a perfectly legitimate way to sound good. Because what is on the income statement? You have sales. Your sales less your cost of goods sold. That's taken out as a different number. And then less your operating expenses. And then sales is also reduced by returns, and then operating expenses will be reduced by interest, depreciation, amortization. That includes in here. And just a little hint, a little foreshadowing, these paper expenses of depreciation, amortization are not going to be on the income statement or the cash flow statement. They're only on the income statement. It highlights what you made and what you spent. But it highlights on a kind of a, not necessarily what you collected. It's not, it's more of a paper kind of, this is what we made. And this is what banks like to see. You have your sales as a gross revenue. Gross meaning before anything else. That's everything. And then cost of sales or cost of goods. These are costs that are directly related to your revenue, okay? So you're going to have operating expenses that are always there. The cost of sales are what's called variable. They vary based on how much of your units that you sell or how much time you sell for your sales if you're a service service firm. So in other words, the cost of sales will be variable. They'll go up and down, and they pretty much are tied to your gross revenues, because that gives a gross profit. And that's also called a gross margin. We're going to have next session, we're going to say in 2 weeks, we're going to talk about the profit margin, but here we're talking about gross margin. And margin is that difference between the revenues and your cost of goods sold. And then you have the overhead. These are fixed expenses, and these operating expenses are going to stick with you. They're called fixed because you can't move them. Whether you have a good month or a bad month, these are going to be your operating expenses. And what you get after that is your net income. Your net profit is what it's called. And that is a number, a little hint, we'll get to this later, that's going to flow to your retained earnings on the balance sheet. Like I said, that's going to the basket in your attic every month till you pull it down at the end of the year. And sometimes it can be represented as a percentage that lenders will look at it and see you have a 2.7% net income percentage. Net margin. So again, this is what it tells you. Look, the income statement tells so much. It tells you your revenues, top line revenues. It tells you how profitable your business is. So your net profit, and of course it flows. And it tells you your net margin percentage. And it tells you your profit margin percentage. Are there any questions before we get to the cash flow statement? Kelly?
There is a question that was dropped in the chat. Do taxes go into operating expenses?
They do not. That's a really good question. Oh, actually, I'm sorry, they do.
Payroll taxes do.
Yeah, taxes. They absolutely do. I'm sorry, I don't know. I was thinking of something else. Yes, taxes is a line in your operating expenses. The operating expenses includes things like taxes. They include things like your licenses and your classes, but absolutely, taxes will go in. And when you have taxes payable, they're going to show up on your balance sheet as well as a liability. If you have any taxes that are outstanding. And in fact, if you have payroll taxes will be part of your operating expenses, and payroll taxes payable will be on your income statement. Good question. I got distracted. Any other
And there's
questions?
another question, in other words, is the net profit after tax.
That's a great question too, and that actually gets to a good question that I didn't get into in this one. But there's a concept called EBITDA. That is to say earnings before interest and taxes and depreciation and amortization. This is EBIT, and you might have heard EBITDA. That's like these are terms that are asked for by investors, and that's a really good question. The income statement, and you can show your EBIT, you can show your earnings before interest and taxes on the bottom of your income statement. I have seen that before. But generally it's more of a thing that you show if an investor is asking for it, or if you're trying to show the investor is expecting to see it. But you could certainly show it on your income statement, the earnings before interest and taxes, earnings before interest, taxes, depreciation and amortization. That is for sure a number. And EBIT is also a number that is used in ratios that you could use these numbers to get to get a good quick picture of a quick snapshot of the health of your organization. Very good. Any other questions?
Not
Very
at this
good.
point. Mhm.
So those are good. That's so EBITDA is a way that you can build out the income statement, and EBIT is a way to build out the income statement to match whatever it is that you're trying to show. So now let's get into the cash flow statement. You're absolutely doing great. This is as dry as stuff as you could do, so you're doing fantastic. Now the cash flow statement is basically what do you have? This is going to be the statement that is going to make the most sense to you from an operations point of view, because it really is going to reflect how are you feeling? Like, why does it feel like I'm really struggling here? Why does it feel like I'm trying to pinch the pennies? This will tell you exactly why does it feel like that, because it shows you exactly how much cash is coming in. It shows you a cash flow statement might show how much cash you start with, or it certainly shows you how much cash it starts with. Then you run it through the expenses, and a lot of the expenses are going to be the same as on your income statement. And then you come up with an ending cash. Okay, you sort of run it through the machine, you end up with ending cash. So this is what it looks like. You start with a current number, beginning cash. And in this statement, there's a startup cost. And then at the end, you run it through the machine and all of your expenses, and you come up with ending cash. And it goes up to the top to the next one. And it's called a cash flow because it flows just like this. It goes from the beginning to the ending cash. The ending cash goes up to the beginning cash, and you go through it again. And you go the 1,200 up to month 2. At the beginning of month 2, it's 1,200, and it flows just like that. And then you have, let's see, what else do we have? The cash flow formula is cash received minus cash paid out. That's the bottom line. And you do want this to be positive. This is the bottom line. When it's negative, that explains why you're struggling in your business, frankly. And it's important to note that this is not profit. We showed on the other line the net profit at the end of at the bottom line, the net income, net profit. That's your profit. When you talk about profit, that's coming off your net income. That's your income statement. This is your cash. This cash, the ending cash, is going to end up on your balance sheet. As we'll discuss, that's just a number for you to know. That's where you ended in cash at the end of the year. Banks will want to see how much cash you got. There's no doubt about that. So in other words, on month 12, you might have $3,430 in total cash, right? That's the cash. And that is the beginning of revenue, that's the beginning cash that for 1,430 that came from the month before, that flowed from the month before and then before that. Anyway, and then you have your additional revenue from that month, and you have returns would come out of that too if you had to give money back. And then you have your total cash for the month. At the end, you have your ending cash is $1,900. And this is after all of your the actual money that you spent came out. So on your income statement, what I didn't show was you would show income, you would show interest on your income statement, all the interest payments that you made on your loan. But what you'd be might wondering, well, what if I have a loan? Where do I show that I'm actually paying money out? And that's where it shows up right here on your cash flow statement. It shows it in a real-time way to show this is where all my money is going. I'm showing my loans out here, and you'll show it right at the bottom here. Typically, it's shown after, it's not shown as an expense, as an operating expense, it's shown afterwards. And the reason why they do that is because when you go for another loan, they'll add their new loans to those loan payments. Just to give you a general idea. And there's your, okay, so this is how they all work together. You've got your end total cash is from total ending cash from the cash flow statement, right? You have your net income numbers that have flowed and flowed all throughout the years, the many years of your business to have a retained earnings. This is the earnings that are retained at the end. And this is, and then this owner's equity is the cash investment made to the made from the owners into the business, and that's what you're doing. Kelly, are there any questions? No. Okay. So we're doing great, and you're doing great. It's time for a knowledge check, true or false. Let me do. Let's see here. Let me go to. All right, let's see. Put in the chat whether you think it's true or false. Kelly, you're going to watch the chat, okay? Here's our first question. The balance sheet provides a snapshot of your business's profitability over a specific period, detailing revenue, costs, and expenses. Is this true or false? Kelly, what did the people say? Overwhelmingly.
It's about 50-50.
Oh, well, well, here's the trick is you got to watch these tests very nice, guys. But you got to watch these tests a little closer because it says the balance sheet provides this stuff, but it doesn't really provide revenue, costs, and expenses. That is a false, because what is it, everybody? That's your income statement. All right. Let's try this again. Unlike the profit and loss statement, that's also called the income statement, the balance sheet is a dynamic representation of ongoing activities. Is the balance sheet where we see the actual operations of what's going on with your cash in the business? Kelly, what do the people say?
Consensus looks true.
Nicely done. Oh, wait, true? False. You
Yeah.
guys are being you guys are being floored by balance sheet. You guys, I'm getting a picture that you love the balance sheet, but the balance sheet is, again, where do you live? Well, do you live in a house? This is not going to say, anyway, that's your balance sheet. Okay, but anyway, I love it. I love it. Maybe it's the way these things are phrased. Okay, we're going to get another shot. We're so far, I'm going to give you the first one. We're 1 for 2. Okay, The income statement calculates the net profit or loss and includes non-cash expenses such as depreciation. Okay, Kelly, is this true or false, everybody? True or false?
We have some false and a few true.
Okay. I want to give props to those who said it was true. The
True.
people who said it was false is probably you're probably trigger shy because you went with balance sheet the first couple times and you're just gonna go false every time now. But let's start fresh. We're gonna start fresh. There are no judgments. We're gonna start fresh with that is correct. The income statement is also called the profit and loss statement. It shows your net profit or your net loss, and it does include paper stuff like depreciation, amortization. So that is true. Let's try another one. Understanding the income statement helps gauge how well your business is performing in terms of generating revenue and managing expenses. Understanding the income statement helps gauge how well your business is performing in terms of generating revenue on one side and managing expenses on the other. Is that true or false, everybody?
False,
Is it-
false. True. We have a mix.
Okay, I like that. I like that you said false because you were listening to me wax on and on about the cash flow statement. But indeed, the income statement does show. So props to you who said true. The income statement does show how well your business is performing in terms of generating revenue, because that is the top line is your revenue line. And you could look at your expenses because the expenses for the most part will be the same between the income statement and the balance sheet. So that is true. We have only a few more. So this torturous test will be over soon, I promise. The cash flow statement tracks the movement of cash in and out of your business, predicting its ability to meet short-term obligations. The cash flow statement tracks the movement of cash in and out of your business, predicting its ability to meet short-term obligations. What do you think? True or false? What do you say? What do you say? The cash flow statement, it's flowing, showing the cash flowing in and out of your business, predicting, it just should show your ability to meet short-term obligations because of your cash. Is nobody answering now because I've already shamed them?
I think we had, no, we have true. True.
Oh, good, good,
true,
good. Well
true,
played,
true,
everybody.
True.
Well
Yeah.
done. Well done. We got it. Excellent. You guys are great. Perfect. Now, it provides a static view of your business financial position at a specific point in time. I would say, let's see, which balance sheet, which statement provides a static view of your business's financial position at a specific point in time? I'm gonna. This is a trick question. It's got to be the balance sheet because that's the one. That's a snapshot. That's the only one that is at a specific point in time. Oh, never mind. Sorry about that. That was one I did very well. My bad, my bad. Um, I thought that was like Jeopardy, where it's like it starts with the answer and then you have to give the question. If it were Jeopardy, we would say balance sheet. A healthy working capital position. Thank you. I'm glad nobody answered that. We are at this point 100% on. We let's see if we could keep it going. Ready? A healthy working capital position ensures that a business has enough liquidity to meet its short-term obligations. Now, to unpack that question, capital position means how much money you have, how much capital, how much funds you have. And liquidity is how liquid you are, meaning how much cash you have. So a healthy working, and how liquid means how much cash you have to, and how much ability you have to pay your liability obligations. So a healthy working capital position ensures that, so working capital is how much money you have for working capital, that a business has enough liquidity to meet its short-term obligations. What do we think? Working capital, I think that might be a trick question there. Let's see. True.
Yeah, we have consensus of true. Good job.
Well done, everybody. Well done.
It's great.
Okay. I think we have one more. Efficient working capital management is essential for optimizing cash flow and mitigating the impact of late payments from customers. True or false? Efficient working capital management is essential for optimizing cash flow and mitigating the impact of late payments from customers. What do you think? What are they saying, Kelly? What that means is you're
True.
managing your working capital expenses. So you optimize. Okay, yeah, what do they
We've
say?
got true. Majority
Yeah.
is true.
True. That's correct. Very good, everybody. Very good. Very good. Oh, there's one more. Let's see. Adequate working capital enables smooth operations, maintaining optimal levels of inventory and handling fluctuations in cash flow. Adequate working capital. Working capital again is how much capital you have that you have discovered that you have. What do you think? Enables smooth operations, maintaining optimal levels of inventory and handling fluctuations in cash flow. And the answer is
True. We've got-
true. Nicely done. Yay. Oh my gosh, one more. Lenders often assess a company's working capital position to evaluate its financial health and creditworthiness. So lenders often assess a company's working capital position to evaluate its financial health and creditworthiness. What do we think companies do? Do lenders look at how much working capital they have? Their capital position to evaluate its financial health and creditworthiness? I'd say, what do you think? True?
True.
True. Well done. Well done, everybody. I want a round of applause. Are there any questions? We've gone through a bunch. Are there any questions? Alexandria has a question, it seems. Alexandria, do you want to come off mute? Can you come off mute? Or you want to put your question in the chat?
I allowed mics. So if you would like to come off mute, you can now.
I was trying to do the applause symbol and I did the hand gesture symbol instead. It was an accident. Sorry.
Oh, okay. Oh, you were trying to clap. Laquanda, you had a question? Oh, no.
Oh, no, I didn't have a question. I did drop our survey in the chat. I know I shared the QR code too, but just sharing the link. This is if it's easier for you all to access it that way. So I just was plugging that in the chat.
Okay. Very good. Very good. Are there any questions? I want to applaud you guys. You made it through a full survey of the very statements that lenders, banks, everybody needs to see, and you can use yourself to analyze your own financial position. So when your CPA gives it to you, you know what you're looking at. Okay, quick plugs, real fast. Sorry, LaQuanda, I had to do this. This is what this is what pays for me to get here. We at the WBDC we have 2 loan products. Just so you know, if you're looking for financing, this is up to $15,000 crowd-based loan for businesses that are that you don't need collateral. It is crowd-based, so you raise the money through 2.5 million 2.75 million entrepreneurs that are on the Kivo website. So that is up to 3 years, and if you're interested, we could talk to you about that. Also, we've got a direct lending program. This is a loan up to $50,000 for businesses that are more than 2 years. We do take collateral, but we don't care about credit score. These personal credit score is not a determinative factor. We look for your ability to pay. If you had losses last year, but you have a good assumptions for how you're going to make up this year and to make money this year, we want to support you on that. So that is our direct lending program, and that is 9%, and there's it's about 4-year term. If you want to do small business advising with us, if you want to meet with any of us for TA, then you go ahead and take a picture of this QR code, and you could fill out the intake form on smallbiz.org, and then you can ask for the Women's Business Development Center, and Kelly will route you to us. So that is if you wanted to meet with any one of us to talk about how to find financing, talk about Kiva or the direct lending program or anything like that. We are a great partner to Cook County. And then just like LaQuanda said, here is your survey. Please go ahead and take a picture. Go ahead and use your camera to get this QR code to take the survey. And well done, everybody. Very good. And that rounds it out. Are there any final questions? And LaQuanda is putting the link in the chat again. Oh, yes, Jill.
Can you please redisplay the QR code? It went away before I could grab it.
Oh, yes, for the survey?
Yes, thank you.
Absolutely. Hold, please. There you go.
Thank you.
Okay. Are there any other questions?
Well, not a question, but thank you so much, Josh. This was so awesome. Lynette and I are in the room together, so we were having a lot of fun with the questions at the end. We were having fun kind of bouncing off each other, trying to answer them. So yes, I just want to say thank you very much. But if anyone has any questions, feel free to ask. But we also thank you so much for joining. And yes, please take the survey, and we will also share out this info as well as the recording in a follow-up email. So be on the lookout for that too.
Cool.
Oh, and do not forget, part 2 to the series is February 26th, same time. I will also send out a sign up link when I send out the follow-up email for you guys. So you will have the registration link, everything, the presentation, the recording. You're going to get it all. One-stop shop, Laquanda. So I'm going to get it to you.
That's great. Thank you for inviting us, and we're looking forward to continuing this series.
Well, all right. If no one has any other questions, we are going to let you go. We thank you so much again for your time, and we hope you have a great rest of your Thursday. Yeah.
Thank you.
Have a great
Bye.
day. Thank you.
Thank you. Have a good day.